Hi everyone. For my presentation, it will be over Chapter 11, the sections for ratio analysis and interpreting business ratios. Ratio analysis. What is ratio analysis? Ratio analysis is defined as a method of expressing the relationship between any two elements on a financial statement and provides a convenient technique for performing financial analysis. An easy way to describe ratio analysis is by comparing it to the dashboard of your car. It tells you everything you need to know about your company and how it's doing. Like with your car, when your tire is low, the tire sensor goes off, and when your sales and profits are decreasing, the ratio analysis will reflect it. There are 12 key ratios that make up the analysis. These ratios help the business owner monitor the company's financial stats. 12 key ratios. The current ratio, which measures the company's solvency by using its current liabilities and its current assets. Quick ratio, which measures the company's liquidity by using its quick assets and its current liabilities. Debt ratio, which measures the company percentage of total assets financed by creditors compared to its owners using the total debt and total assets. Debt to net worth ratio, which shows the relationship between the capital contributions from creditors and those from the owners by using total debt and tangible net worth. Times interest earned ratio, which measures the company's ability to make the interest payments on its debt using earnings before interest and taxes and total interest expense. Average inventory turnover ratio, which measures the number of times its inventory is sold out using cost of goods sold and average inventory. Average collection period ratio is used to tell the number of days it takes to collect accounts receivable by using credit sales and accounts receivable. Average payable period ratio, which is used to tell the average number of days it takes the company to pay its accounts payables using the purchases, accounts payable, and the days and accounting period. Net sales to total assets ratio, which is a general measure of its ability to generate sales in relation to its assets using net sales and total assets. Net profit on sales ratio, which measures the company's profit per dollar on sales by using net profit and net sales. Net profit to asset ratio, which tells how much profit a company generates for each asset by using the net profit and the total amount of assets. Net profit to equity ratio, which measures the owner's rate on an investment by using the net profit and the owner's equity. Interpreting the business ratios. Understanding the ratios. These ratios can be very helpful in calculating a company's performance, but the entrepreneur must know how to calculate the ratios and how to interpret them also. However, not every business uses the same ratios. Some businesses alter and create their own ratios in order to fit what they are trying to monitor about their company. These ratios that they create are known as critical numbers, which are defined as the indicators that measure key financial and operational aspects of a company's performance. Many companies in the same industry have different critical numbers. What's important, though, is that you identify your company's critical numbers, monitor them, and drive them in the right direction. Comparing ratios. Another thing that could be very helpful is to compare your ratios with other companies in the same industry as yours. This helps you identify where your company is flourishing and where you need to work on it at. In the book, it uses examples of medical tests in the healthcare profession as an example. It says, just as a healthy person's blood pressure should fall within a range of normal values, so should a financially healthy company's ratios. A company should always want to stay near these normal values, but it's always good to be above normal. If a company falls below these normal values, they can't stay below for too long because it won't be successful for much longer. Interpreting the ratios. A helpful way to interpret these ratios is to calculate the variance from the industry mean, which helps the company identify what areas of the company are out of line compared to the normal company in the same industry. A company should always want their stats to be somewhat as good as the average numbers. The main goal should be to manage the company so that its numbers are above average. Also, one thing to remember is that when comparing numbers and ratios, that the ratios are going to look different in some cases. Just because the numbers and ratios look different doesn't mean that the company is doing bad or that the ratio is incorrect. Instead of making a lot of changes to the ratios, the company should do some research to see why the numbers and ratios don't compare. Another important thing a company should do is analyze their own ratios from time to time. These are an easy way to get a quick look at the way a company's trends and to see what can be done differently. Thank you.